In this topic, we are going to review one of the most heavily tested areas of the CPA exam, loss contingencies.
Let's get started. We are going to learn to distinguish between a loss contingency and a gain contingency. The exam loves to test the differences. PRR rule, this is very important. If you cannot remember anything from this session, just remember this one. We are going to learn how to apply two-step tests for recording the loss contingencies. In exams, they usually give you an estimate. We are going to learn how to handle ranges and have some CPA exam style questions. What exactly is a contingency? A contingency is an existing condition with uncertainty about possible gain or loss resolved by future events. So here what we need to pay attention is an uncertainty. And there are two types of contingencies. The first one is a loss contingency, which is maybe there's a potential lawsuit, maybe there's a warranty, or an environmental cleanup obligation. And the second is the gain contingencies. Maybe the company sued someone and we are expected to get something, or maybe we are expecting some insurance payout. So those are all considered gain contingency. And what does the exam ask the students? So they want to know, we can identify if it's a loss contingency or gain contingency, and they want to make sure that we can understand the probability level. So here you are going to hear three different words: probable, reasonably possible, or remote. The exam wants to know if we can determine the probability level and calculate the amounts to record or disclose. Let me give you the framework for handling loss contingencies. There are three steps you need to follow every time. Step 1, assess the probability. Is this loss probable, reasonably possible, or remote? How do you know that? Usually the exam explicitly gives to you. It says you spoke with the company's lawyer and they said it's reasonably possible, or they say it is probable. Number 2, you determine if the amount is estimable. So can you reasonably estimate how much loss is going to be? Sometimes the exam gives you a specific amount or a range, that value. Step 3, apply the appropriate treatment based on your answers, number 1 and number 2. So based on the answers you see here, you decide whether you need to record it, disclose it, or do nothing. In the exam tab, look for the words probable, reasonably possible, and remote. Think about the most important framework in this entire topic, the PRR rule. This is the most tested concept for contingencies, so listen carefully. P stands for probable. If a loss is probable, you record it, make a journal entry, and disclose it in the footnotes. The first R stands for reasonably possible. If a loss is reasonably possible, you reveal it, disclose it, no journal entries. For the PRR rule, if you hear remote, you just relax. What does it mean? You do not make the journal entry and you do not disclose it in the footnotes. So here's the exam tip. This PRR framework is the foundation of everything. The exam will give you the probability level, then we'll ask you whether you know if you need to make the journal entry or if you need to disclose it. Here we have one critical exception, which is the guarantees. Let's go it on the next slide. Critical exception for the PRR rule, and it is a major exam trap. So pay close attention, because in the exam they give you things like debt guarantees, lease guarantees, performance guarantees, and say remote. When students see remote, they think PRR rule, remote, relax, we do not need to do anything. But this is an exception. Guarantees must always be disclosed, even if the probability is remote. If you see the guarantee, you're going to disclose. Even if it's remote, you still disclose. This is important. When you record a loss contingency with a journal entry. For this one, there's a two-step test you need to apply. And we have two conditions. So number one condition, the loss must be probable. And the number two condition, it must be estimable. So what does it mean? Sometimes in the exam they give you some loss contingency, it is probable, but they don't give you an estimate, or they give you an estimate, but they do not give you anything for the first step. So when that happens, you do not record it. This one is important. You only record it when both conditions are met. And how do we do it? We debit the expense and we credit the liability. This is a very simple journal entry, but the exam trap is the two-step test. Make sure conditions are met. But gain contingencies. The exam loves to set a trap for the candidates, and here is the rule for the gain contingencies. You never record it until realized. Why is that? Conservatism. We are conservative about recognizing gains, but not about recognizing losses. We might disclose a gain contingency in the footnotes if it's probable, but we never record it. Here's the exam trap you might see. The exam will give you a gain contingency that is probable and estimable. So it's going to be something like, maybe they're going to describe a lawsuit to your company, you filed it, and your lawyer says it's probable you will win 500,000. Then they're going to ask you, what should you record? And one of the answers would say record a receivable 500,000 because it's probable and estimable, which is the case for loss contingencies. This is the wrong answer. You never record it. Conservatism, if there's a gain, we do not record it until realized. One way to remember it is gains get gone. An example, you might see a multiple choice question which starts something like that. Your company here, our company is Tech Corp. We are sued for patent infringements. They filed a lawsuit in year 8. At the end of year 8, here are the facts. We contacted our legal counsel. He said probable loss. Remember from our PRR rule, if it's probable, we record it. He gave us some estimate. He said it's going to be between 800,000 and 102 million. It's expected to resolve in 2009. And the question is asking us, what should Tech Corp record in its year 8 financial statements? And here are the options. So it says no entry required, footnotes only. No, if this was a gain, that would be a thing because over there we are more conservative. But if it's a loss contingency, no, we do not do that. And then it says, okay, record a loss of 800,000, 1 million and 1.2 million. I believe the attorney said it was between 800,000 and 1.2 million. And this question gives you all three examples. Which amount we choose? We choose the lower amount here. The answer is going to be B. We are going to record a loss of $800,000. And here is also solution and analysis. So why is it correct? It says it's probable we met the first condition. They give us an estimate amount, a range, based on, because like the both conditions are met, we are recording it. If there is no best estimate, we use minimum. If the attorney told us the best estimate is 1 million, we use a 1 million, but because there's a range, I use the lower one. The journal entry, debiting the loss 800,000 and crediting the liability 800,000. 6 memory tools to help on the exam day. First, the PRR rule. If something is probable, record it. If reasonably possible, reveal it. If remote, relax. Second, the LED test. So when do we disclose and record? If the likelihood is probable and if we have an estimate amount, we disclose and record. If one of the conditions do not meet, we do not record it. We still disclose though. So something happened, amount is estimable, loss probable, we make an entry because there's a statement impact. In the exam, if it gives you like a range, when there is no amount is more likely, use the minimum. Do not use the midpoint, do not use the maximum. For the gain contingencies, we never record the gain contingencies until realize, regardless of the probability, because of conservatism, gains get gone. For guarantees, this one is an exception. If we have a guarantee, even if remote, for the PRR rule, we always disclose it. Came to end of part 1. What we covered here, we covered the PRR rule framework. We covered the two-step test for recording. We covered the gain contingencies, which we never record, and we covered the guarantee exceptions. Let's see you on the second part of the lecture.